Oh, there we go. Morning, team. Got to get rid of that one. Hey, welcome to another Wealth Coffee Chat, folks. Good to see a few of you on this morning. The early bird catches the worm, they say. Good morning, Kevin. In the evening, all the way from Florida. Allison. Diversifying. Hey, that's fantastic. I might nick that. Whoever did that, diversifying. Good job. Hey, good morning, Jeff. Brendan. James, bit of whiplash there. Bryce, good morning. Hey, listen, thanks for joining me. Another Wealth Coffee Chat, folks. Good to see you. Good to see you. Hope you're all awesome and well. Morning, Deb. Dashing Deb. We'll see you this evening, Deb. There we go. Quick intros before we get on with it. This morning, Jason Witten's my name. Most of you know that, but if you don't, there you go. You know my name. You know what we're up to. It's called the Wealth Coffee Chat. We do it in the mornings, Monday to Friday during the week, just to keep the wheels on this go-kart that we have, maybe the race car or whatever it is of our property investing goals. Been property investing myself well over 20 years, coaching property investors across Australia and New Zealand for a while too. And along the way, learned a couple of things. And each morning, if we're lucky, something might fall out of my head about the experiences that we've had, coaching well over 7,000 people across Australia and New Zealand to buy many, many, many thousands of properties. So there you go. Anyway, that's the drill. Give us a shout out. Say a quick hello in the chat if you're new, where you're from. Roscoe, mate, I love that. Diversification. Awesome. Fantastic, man. Listen. Nev, I haven't seen you for ages, mate. How you doing? We should get together. Catch up again. Alex, all the way from Cairns. Good to see you, Alex. Anyway, there you go. Deb's in Brizzy. Hey, this week we're doing, we've got 2 days. Just a little plug. We're doing something special with business owners up in Brisbane. We've got 2 days. We're calling it the exit plan. And we've got about 30 business owners flying in from all over the place, and we're going to hang out, do some cool stuff, and create a very cool business exit plan. So if you're in business and you want to know more about it, give me a shout out. Let me know. Let me know in the chat. Deb can hit you up because as business owners, there's some different things we've got to do compared to people who've got regular jobs. You know what I mean? So there you go. Away you go. All right, I better get on with this because if we don't, Elizabeth, all the way from Perth, I'll run late, and that's never a good idea. Hey, diversification, as they say. Roscoe, we need to catch up, man, as well. Let's have a look at this. Have a look at the idea. Lee, all the way from Tassie, good to see you. The idea of diversification, where did it come from? Where is it? I mean, I hear it all the time. Go back to this. I hear diversification all the time when it comes to the world of financial planning, and my experience has been someone who's not a specialist in particularly any asset, they don't know particularly deep, intimate knowledge about one asset and how to make money from that asset. They come up with a way of saying, hey, I'm inexperienced and I don't know. And I haven't created wealth from these assets. So you know what you should do? You should diversify. You should buy some of this and some of that and some of this and some of that and some of this and some of that and blah, right? In my experience, that's a terrible idea. Now, the idea that diversification is some sort of protection mechanism from something, the world of stocks and the stock market. Why do we need to diversify and have some protection against the volatility of the stock market? Well, here's an example. I'll show you a quick example. Anyone hear about Bed Bath and Beyond share price of recent times? I'll show you over the last 6 months. Just check this out. I mean, here you go. 6 months ago, the share was worth, there you go, $23. $23. $23. Now, obviously, you know, the share price went up. It was going great guns. Even if we went out to 1 year, look at this. You know, big rally. Yay. Up goes the share price. Significant increases, by the way. So this is probably the attraction. Anyway, I'll get on with my point. Google tanked as well. Yeah, it tanked. So it went from $23. So you think, you beauty, down to what? $1.93. Kidding me? Woo. Dusting your dough. Talk about dusting some dough. Anyway, that's a cliff. Now that's a cliff, Brendan. There's a cliff for you, brother. You know, the property cliff might be an adjustment of 5% in the marketplace. But you know what? You can go from 23 to $1. What's the percentage of value lost there? Someone do that for me on the fly, folks. Someone do that for me on the fly. So, you know, the point is, when you are an investor, things can get volatile, things can go sideways, things can get a bit hairy, no matter what you're investing in, whether it's real estate, whether it's shares, whether it's your business, you know, it's too much, Tim. Dead right. You know, and we need to understand how we can, as investors, you know, protect, you know, our efforts, our investments over time to make sure, we make the most of it. So the percentage is heaps. It's a technical term, heaps, Brendan. I like it. But anyway, let me get on with it today. The idea when it comes to real estate, it can work when it comes to the idea of real estate, diversifying, but not in the way you think. For me, for you. Now, tell me in the chat here, if you're thinking real estate, let's get real estate specific. I'm a big fan of you as an investor really knowing an asset class that you're very familiar with. And if you know it well, you'll always be ahead of the market when it comes to making decisions of creating wealth from that asset class. Real estate, for me, has been that asset class. I know a lot about it. I teach you guys about it. You guys have joined our coaching and mentoring program. We learn together. We know a lot about this idea, right? So put it in the chat for me just quickly if you've got the capacity. What would be, what would somebody say? Oh, if you're going to diversify in real estate, you should diversify this way. And some of you might already know this, but just pretend that there's a conversation going on by diversifying in real estate. You should buy different types of real estate. Chuck it in the chat if you want to. But, I've heard these conversations. Oh, you should buy some residential. You should buy some commercial. You should buy some industrial. You should buy some retail, and again, for me, for you, I think that's super flawed. Not a great idea. Because each one of those categories for property is a category that requires a lot of learning and a lot of understanding. All right. So I want to talk about the idea of diversification and not making, what was it? Diversification. What was that one again? I loved it. I think I'm going to write that down. Diversifying. That's it. There you go. We're not going to make it diversifying when it comes to our property portfolio, folks. We're going to use the concept of diversifying smartly in a way. How can we do that as property investors? How can we use diversity to make sure our property portfolio is much more robust when it comes to the world of property investing? So let me take you through it this morning when it comes to this stuff. Put it in the chat. What do you think? There's a number of things. There's 4 or 5 things that we can do when it comes to the idea of diversity, when it comes to our residential buy and hold investment portfolio. Folks, all right, let's do this. All right, the first one, we call it the 5 cities plan. And Alison, you'll notice today I've got a pre-drawn map of Australia. So then I don't know where the borders go. Anyway, I can just draw this in. I think it's like this, isn't it? Is it like that? No, Adelaide's a bit closer. Anyway, I can just draw that in and not cause myself any grief. I'm sure it's there anyway. Should have done it beforehand. Like that. Is it like that? Anyway, there you go. There's Australia. Nice and neat today. But the idea, one of the things about a 5 cities plan is having the capacity for you to have economic exposure, economic. There you go. Economic. I think there might be a double C in there somewhere. Double C. Economic exposure for different states in Australia. Also, different property markets. One of the big reasons that we like the idea of, we teach the 5 cities plan. They are the 5 major cities that drive, and you can swap out Adelaide for Canberra in that as well. So Adelaide and Canberra kind of exchanging. So Brisbane, Melbourne, Perth, and Sydney, the big kahunas. Adelaide and Canberra, secondary. And then you've got some fringy things that sort of make up the edges of, places like Brisbane and Melbourne and Sydney. Anyway, here's the idea. Why do we want to diversify? Well, when you buy real estate, there's a thing called land tax, right? So if you own 5 pieces of real estate in Queensland, well, you'll get slugged land tax as a property investor, and it can be pretty significant. But if you're building a portfolio, folks, and you own 1 in Queensland and 1 in New South Wales and 1 in Victoria, 1 in Perth, and let's say 1 in Canberra, you will pay 0 land tax. So it's the difference between paying $0 and $10,000 a year in land tax. Now, I don't know about you, but I think that's a smart reason to diversify when it comes to our property portfolio. Yep, I do. Right? The other thing, and we're going to talk about this stuff, is like, what do we buy? When do we buy it? How much? Blah, blah, blah. Let's go through the process. Different markets grow at different times, over a period of time. And I might update this little slide as well. Different markets grew. Perth did well. Then you've got Adelaide did well. You've got Darwin doing well. You've got Melbourne doing well. Sydney, Darwin again, Perth, Sydney, Melbourne, right? So when you diversify across different markets, often at least one of those markets has some positive movement in its values, in its rents, in its whatever. Over the last little bit, when it came to the world of, the last 3 years, many markets moved at the same time. Let's say you had some capital growth movement up and down the East Coast, but Perth was left well behind. And so Perth is getting a run now as we go. The rents started to grow basically New South Wales and Queensland, and Melbourne was left behind because of the COVID lockdown, right? So now let's say the rents in Sydney and Brisbane are slowing down a little. Well, Melbourne's picking up with the rents accelerating, et cetera, et cetera. So different markets at different times. And how can we take advantage of these different markets at different times? Well, there's 3 different types of markets. So diversifying in markets, a counter cycle market. So a downward market. Tell me in the chat, folks, in a downward market, what type of buying would we be doing in a downward market? Chuck that in the chat for me. Tell me if you think you might know what that purchasing might look like, or the strategy. I'll talk about that in a minute. Anyway, I've only got 3 minutes till 8:30. Always bite off a little bit more than I can chew in these wealth coffee chats. I think, yeah, I'll get through that, and then I never get that. Anyway, the idea, if you got a market that's got some pressure, you might buy discounts, right? You might go buy discounts. And we've done lots of discount buying over the years. The rising market, the last few years, well, you're going to get growth from the market momentum, okay? And in an independent markets are things like a new land estate, a whole new building with a new quality. Well, that gets set by the quality and supply of that piece of real estate in an independent market, right? Oh, you can't see that as we go. So diversify in location for exposure to different markets and minimizing your land tax. Diversify in different styles of properties. An older property or a newer property, they have different reasons that you might purchase an old property. If you're going to renovate, rejuvenate, add value, you might buy a newer property because it's much more modern. You get higher depreciation, often higher rent. So diversifying of your strategy. The other idea when it comes to diversifying your income, when it comes to residential real estate, you buy a property that at some point in the future, you can turn it into Airbnb or short-term letting, okay, as we go along as well. And for you as a property investor, we could diversify across different types of property deals, right? We could do a subdivision, a reno, a knockdown rebuild, a development or a discount. You could buy off the plan, diversify investment types as we go as well. So the idea, little croaky frog, and last but not least, diversify across different price points for different qualities of properties. All right, as we go. So in the classic sense, team, it certainly is diversifying. The idea of like, hey, you're just getting to know real estate. You just bought a couple of properties. Now let's not get too risky. Now let's take the next bunch of your money, put it in places you have no idea about and little control about. Let's buy, X or Y and give it a punt, right? Because that's a good idea to diversify your risk. Well, I think that's rubbish and bullshit, personally. I think you should get extremely good at knowing what you are doing with an asset class that you're comfortable with, whatever you choose. And that's how you can make good money, good wealth. And in that asset class, let's say real estate, you can diversify and strategize to make sure your investment process is very robust and medium to long term will get you a really good result and outcome. Anyway, there you go. Hopefully that was useful. Diversifying, not diversifying in the world of property investing. All right, that's it, folks. Wealth Coffee Chat done and dusted. Hey, listen, tomorrow I'm not going to do a Wealth Coffee Chat Friday morning. I might pop in for a couple of minutes with Andy Fenton. However, tomorrow afternoon, Wealth, Wine and Wisdom, while everyone's still on, we're going to do a live Wealth, Wine and Wisdom from Brisbane with about 30 people in the crowd. So join us for that at 4 p.m. Queensland time, 5 p.m. Sydney, Brisbane, and wherever the rest of you are. You can work it out. But join us for Wealth, Wine and Wisdom, Andy and I, glass of wine, and we're going to talk about a lot of investing concepts and strategies as well, folks. So there you go. I might pop by just quickly tomorrow morning, but it won't be a big one for Wealth Coffee Chats. And make sure you put it in your calendar for Wealth, Wine and Wisdom tomorrow night. Anyway, it's Thursday. This week's gone quick. Absolutely flown by. Anyway, there you go, folks. I'm just rabbiting on now. All right. This is it. That's done and dusted. Wealth Coffee Chats over and out. Thanks for joining, folks. Good to see you. And join me for another one, maybe quickly tomorrow, and next week we'll get into it again. Until then, you guys take care. Remember, this thing's a marathon, not a sprint. It takes time to build your property portfolio. Don't get bored. Stay on track. Stay on target. And buy well and don't sell. Buy something you're happy to own forever. Pretty simple. Easy to say. Sometimes pretty hard to do. Anyway, there you go. I'm just rabbiting on now. See you, folks. Good to see all of you. And take care. Bye for now.